If you are thinking about selling an investment property later in life, this is one of the most important conversations you can have before you sign the contract. Today, I want to walk you through a real example of a couple in their early 60s who sold the investment property, realized a large capital gain, and were able to legally eliminate their capital gains tax by using unused superannuation contribution caps. Hi, my name is Helen Nan. I'm a certified finance planner and author of a finance book. The information I'm sharing today is general advice only, not personal advice. So please make sure you read the full disclaimer below. In this video, I will explain how unused super contribution caps can be used to reduce capital gains tax, a real-world case study with actual numbers. The eligibility rules and risks you need to be aware before using this strategy. Paul and Lisa are a couple in their early 60s. They sold an investment property they had owned for around 12 years. When the property was sold, they realized a capital gain of approximately $600,000. Because they held the property for more than 12 months, they were eligible for 50% capital gains tax discounts that apply to individuals in Australia. This reduced the capital gain from $600,000 to $300,000. The property was jointly owned, so the taxable gain was split evenly, $150,000 taxable capital gain each. At this point, many people assume there's nothing else they can do to simply accept the tax bill, but this is where good planning can significantly change the outcome. Before selling the property, Paul and Lisa each earned $80,000 per year in taxable income. On net income, they paid roughly $16,388 each in income tax. Once the property was sold, their taxable income increased by $150,000 capital gain. That took each of them from $80,000 to $230,000 in taxable income for that year. On an income of $230,000, the total tax payable jumps to approximately $75,378 per person. That means their tax increased by around $58,990 each, or almost $118,000 in total for the couple. For many people, that is a large and unexpected tax bill. This is a point where many people feel stuck, but this is also where planning makes the biggest difference. Paul and Lisa were self-employed for most of their lives. As a result, they had contributed very little to superannuation over the years. This meant they had huge unused concession contribution caps from previous financial years. Here, the concession contribution caps of the last 5 financial years, including the current year. The total available concession cap over these years was $167,500 per person. Assuming they had made concession contributions during those years, each of them could make a personal deductible contribution up to $167,500 by using last 5 years and the current year's cap. Claim the full amount as a tax deduction. Substantially reduce their taxable income in the year of sale. After property sale, each person's taxable income was $230,000. By using their unused concession contribution caps, they were able to reduce their taxable income by $167,500, bringing it down to $62,500 per person. Now, concession contributions to super are taxed at 15% inside the super fund, so on a $167,500 contribution, the contribution tax comes to $25,125. Let's compare the outcomes. Without the strategy, the tax payable on $230,000 of income was approximately $75,378 per person. After applying the strategy, the income tax payable on $62,500 dropped to about $10,725, plus $25,125 in super contribution tax. When you put it all together, the total tax saving came to approximately $39,528 per person, or nearly $79,000 for the couple. And importantly, this money was redirected into superannuation to support their retirement in a much more tax-effective environment. This strategy does not work automatically. There are several critical eligibility rules. To use unused concession contribution caps, your total super balance must be under $500,000 as at the 30th June of the previous financial year. If you are under age 67, you can generally make personal concession contributions. If you are age 67 to 75, you must meet the work test. What is a work test? To meet the work test, you must work at least 40 hours within 30 consecutive days. In the same financial year, you make the contribution. If these conditions are not met, personal deductible contributions may not be allowed. Capital gain tax is triggered in the financial year the contract is signed, not when settlement occurs. This means super contributions must be made in the same financial year. Unused cap must be confirmed before the sale. Cash flow needs to be planned carefully. One of the biggest mistakes people make is selling first and asking questions later. By the time the tax bill arrives, many planning opportunities are already gone. There's one very important step I need to mention because without it, this whole strategy does not work. If you make a personal concession contribution and want to claim it as a tax deduction, you must lodge a notice of intent to claim a tax deduction with your super fund. Making the contribution alone is not enough. After contribution is made, you need to complete the notice of intent form, usually available from your super fund, and send it to them. The super fund must then confirm it in writing. Only after you receive that confirmation, you can claim the deduction in your tax return. The timing matters. The notice of intent must be lodged before you submit your tax return or before the end of following financial year, whichever comes first. If you miss this step, lodge your tax return too early, or withdraw or roll over the money first, you may permanently lose the deduction. This is why getting the timing and the paperwork right is just as important as the strategy itself. Is this strategy right for everyone? It's important to be clear. This strategy is not suited for everyone. Whether it works depends on your total super balance, your unused concession contribution caps, your age and work status, your income level, and your broader retirement plan. Reducing tax should never come at the expense of lifestyle flexibility or peace of mind. The big takeaway is this. When the major events like selling an investment property is coming up, planning ahead can make an enormous difference. In Paul and Lisa's case, unused super contribution caps turned a large capital gain into an opportunity to strengthen their retirement position. If you are approaching a property sale or you build most of your wealth outside of superannuation, this is exactly the time where professional advice can add real value. If you found this helpful, please subscribe for more practical, real-world financial planning insights. To learn more, visit compoundfreedom.eu and I will see you in the next video.